questions?
I wasn't sure if there were any. I don't know. I think Mitchell might have been answering them along the way, but I didn't see any that were.
Here's one from Josh. How far out from retirement do you recommend starting to shift from growth to balanced and then defensive assets?
Yeah, that's again is where market timing comes in, Josh. They do say that my children who are the age of 35 and 33, I said they're in high growth assets, and I said you want to stay in that until you're at least 55, 60. I think it's when your income sources start to change, you should start looking at shifting. So in other words, if you're moving from full-time to part-time, you want to be moving away from 100% growth assets. Probably at the age of 60, you want to be in 70 growth, 30% defensive. And as you get closer to 65, you want to be moving to more of a 60, 40, 50, 50. But as I mentioned, I will touch on that earlier because there's some interesting statistics or financial analysis that says you can actually start with defensive assets and move more into growth assets as you get older, which is an interesting way to look at it because you've got less time.
Mattia Tabachi says, in terms of setting up a debt before retirement, is it better to have an investment property with a mortgage, rent it out, or sell it prior to retirement?
Well, I think that comes down to negative gearing, Mattia. I mean, it's more, if it's negatively geared, you want to be probably sorting it out before you retire because you're deducting the interest against your earned income.
Yeah.
So you got to look at that. Yeah.
And the problem with negative gearing is you actually are incurring a loss. What you're deducting is a loss, and you have to incur the loss before you get deducted. So firstly, you've got to have income to deduct it against, and secondly, you've got to be able to fund the loss in the meantime. And so if you're in retirement, any property investments you've got really should be positively geared. But if you've got a positively geared investment property, that's fine. Keep it going.
Keep it going. Exactly. Yeah. It's a good source of income. Yeah.
Exactly.
And typically, Alan, that will be inflation, adjusting. The rent will go up with inflation. So it's actually quite a good.
Right. Yeah. No, it's good. It's good. Just bearing in mind that the rent is taxable. Well, it's fully taxable, whereas other things may not be.
Yeah.
Des Egan says credit cards are great for cash flow management, but banks are loath to issue credit cards to retirees regardless of income. Yeah, fair enough.
Yeah, no, that's true. Yeah.
Just hang on, but just hang on to the ones you've got is what Alice is saying.
Yes.
I mean, are the banks? I haven't encountered this yet, but are the banks likely to take a credit card off you when you retire?
Well, one card issuer, I won't tell you which one it was, put the fees up when I retired. Well, after I got over 65. And I rang them and said, why are you putting the fees up? Well, you're over a certain age. So I think they were actively encouraging me to cancel the card.
Come on, tell us who it is.
No, I can't do that. No. I'm supposing that they were being ageist. I think they would deny it, of course, but
they're rat bags. We should out them.
We should out them, exactly. But
Mark McAllister says, regarding setting up a debt facility pre-retirement, could this be simply an existing home loan redraw facility? The answer is yes, Mark. It can be.
Yes, which is what I've got. Yeah.
Yeah, I've taken a mortgage and I've got all the money sitting in an offset account.
Yep.
Yeah. Emmanuel says, why get to debt in retirement? I don't think we are saying get to debt in retirement, are we?
No. What we're saying is, use your, rather than what we're really saying use your house as an asset to borrow money short term, but we're going to say you want to try and pay that off because it's not deductible. I mean, Manuel's right. You don't really want to be incurring huge debts when you've retired.
No. Pension phase. Wendell Raven says pension phase of super has a minimum drawdown amount you must withdraw. If you don't spend all of that, is there a way to return it to your super after the financial year?
I think yes, if you keep, and I'll caution that I'm not a tax expert, and I would recommend that you get tax advice on this one. My understanding is that if you take money out in a pension phase, so if you have your super fund with a pension phase and an accumulation phase, you take it out in the pension phase, you can recontribute if you still have a portion in accumulation.
Right. Good.
Yep.
Julie Speechley says, if you have excess cash, would you make non-concession contributions or invest in the market outside super?
That's where I touched upon this, whether you want to keep some money outside of your superannuation, depending on how old you are, Julie. If you put money in, this age, so like take my children as an example, they've both got properties. They do have a little bit of surplus cash. At the age of 35, my advice to them has been, don't necessarily put it all into super because you won't get it out until you're 65. If you've got some excess cash, pay down some of their mortgage. Now, they've both got mortgages. If they didn't have a mortgage, it's probably a slightly different, recommendation. I would probably tell them, I would put probably half of it into super. If you could do it as a concessional contribution, obviously it's more tax advantage to you, but as a non-concessional contribution, it's a very tax effective place to save money, as long as you don't need it until you're 65.
Yeah, that's good. Sally Apocus says, is there other advice for what we can't access after 65 years of age, like a credit card, which is news for me at 62? Well,
Sally, I'd have a look through I've done about 4, I think it's 4, maybe 5 diaries of a self-funded retiree. And I started one of these before I haven't retired yet. As Alan knows, I'm still doing these webinars with him. But things I have thought about to get ready for retirement. There's a couple of things in there. The credit card and debt facilities is one. There was another one, which I can't quite remember, but if you have a look through those, there's a couple of other items, I think, which I mentioned.
Yeah. I can't think of anything else. And in fact, the thing to do is to hang on to the credit card you got.
Yeah. Well, I think, and the other one I think I did recommend is just simplify all the bank accounts and things you've got. When I went through all my stuff and I discovered that I had about 4 different bank accounts, some of which had no money. One of them had a little bit of money in them. So it's worth doing a bit of financial housekeeping at some point and just take off the card. Make sure you've got at least 1 credit card, probably 2, and they don't charge you too much in fees. And then simplify all the other banking arrangements that you have.
Mitchell Datson has put a link, Sally, to the Alastair's issue 1 of Alastair's series of the Diary of a Self-Funded Retiree. So there you go.
Oh, there you go. Thanks, Mitch.
And Joe Sest says, are there any issues with having both an SMSF and an industry super fund?
No, in fact, Joe, there is an advantage in that. So I had both until about a year ago. The reason I kept I didn't have an industry fund. I had a Colonial First State public offer fund, and they gave me a very attractive life insurance product. The premiums I was paying was probably much cheaper than I could get anywhere else for a life insurance, TPD, total and permanent disability insurance product than I could buy myself. So it was worthwhile keeping them both. When I canceled my life insurance policy about a year ago, I thought I might as well merge them all into one because it just simplifies my life.
Very good. Well, we seem to have run out of questions, Alastair, and as always, it's been a great webinar, very informative. Hang on. One more before we go from Bob C. Do you recommend WARP products? Pros and cons. WARP. Do you know what that is?
No, I don't. Oh, is that a wrap? Do you mean a wrap, Bob?
Oh, yeah. He probably does.
Sorry, wrap products are what is a wrap? A wrap's just a platform. It's a platform where you can keep all your assets, and it, gives you a summary of all the things you've got. Now, the only problem with a wrap platform is you've got to pay for that. It's just an easy way to see all the assets you've got. I'll do a wee plug for InvestSMART. We have a platform where you can put all your assets on there and see them all, and we don't charge you anything for seeing all your assets in the one place. So look, wrap, there's a whole lot of platforms. Some people use wrap platforms because their advisors recommend it. It makes life simpler for the advisor to look after things and to see what's there. As again, I think it goes back to fees and costs. Make sure you're not paying very much for it, because it's really just a bit of accounting software that tells you what you've got.
Very good. Well, that's it. Thank you very much, Alastair. What a good thing.
Thank you, Alan. Cheers.
Cheers. And thanks to everyone for being a part of this little webinar. It was great. Good questions from everyone. See you around.
Thanks.